what's interesting about Johnson & Johnson has very little debt and very little pension liabilities. So it's actually a very good company. So we're expecting, this is going to happen in Q2 23, we're expecting there to be value creation out of this one.
My guest today is Jim Osman. Jim is founder of The Edge, a research firm that analyzes investment opportunities for hedge funds and global money managers. He brings more than 3 decades of knowledge and experience to the table. And when it comes to spin-off, special situations, or corporate events, well, he's the one I turn to for actionable ideas. He's also a senior contributor to Forbes magazine, where he writes a monthly column. I recently sat down with Jim and we talked about how wealth can be created when the stock market is falling and what areas he's looking at right now. Jim, thanks so much for coming on the show. I greatly appreciate it. And I've known you for, I think, 7 or 8 years. And every time we get together, I always learn so much from you.
Thank you.
Jim, yeah, you sell research. Before we even start, I just want to let our audience know, you sell research services to global asset managers like hedge funds and big money managers. And they pay you $12,000, $20,000, really big numbers. Why do they pay you so much money?
Yeah, that's a great question. And, let's take it another way. Someone might argue, well, if you're so good, why aren't you doing it? Well, as you well know, there's a big uphill struggle to even raise cash at any point in the cycle. And that's always a big job. I've just been passionate about helping money managers and helping people who, just are really careful with their money, not to lose it. And I think the goal really of any research, of any product that anyone signs up to is just that. Start with a risk, and I think that in our area of spin-offs, it negates a lot of the risk just from the fact that the situations can be quite lucrative. So you have a natural downside protection. And that's what's drawn me to the space where, in a world where, let's face it, and arguably everything is cheap. Everything is cheap out there. There's great companies on sale at the moment, but you buy them and they're 10% cheaper the next day. So how does that work? Cheap names can get cheaper. But in the case of, just to answer your question, we look in a very niche space of spin-offs and special situations, which, have a natural downside protection in the way they're orchestrated.
Okay, so great. So I want to get into that because your company, The Edge, you focus your research on a very small area of the marketplace where most investors don't even go to. And in that area, which you're going to talk about in just a second, for example, spin-offs, and you'll share with us what exactly those are, most people don't get that the less investors in a space, the more inefficient the pricing is and the greater the opportunity. Is that more or less right?
Pretty much. The line I always use, Charles, and the line I tell everyone, it's not, it doesn't necessarily mean being first or how smart you are. It's looking in the right places. And frequently we can get very sidetracked, and investors get very, very sidetracked with just focusing on, especially in these sort of markets where where it touches their emotion. They say, well, Amazon's a great company. Why is it down? I'm going to hold on that forever. I should buy more, and they're looking in the wrong places sometimes in where the real value is, especially with spin-offs. We can discuss that in this sort of market. So, what I say to them, there's only 3 ways to make money. There really is. It's insider information, which you'll go to jail for. It's faster dissemination of information, which computers are going to beat you every day of the week these days. That was great 40 years ago. But smarter analysis. And it's only in smarter analysis that investors are going to make money. What is your analytical edge of saying this stock is cheap? Well, we all know that. But then again, what's the behavioral edge of yourself, what you have in the market compared to everyone else? Like, I'm not going to buy a stock, right? If we all agree Amazon's cheap, we ain't just going to buy it. It's going to go up. We're going to sell it and make money, right? It just doesn't happen. We have to be different. And frequently in my years of investing that, stocks don't start off with a huge upside and they realize it. They evolve. And that's very important to look at for investors to understand that one, they've got to be looking in the right place. Two, they've got to have the smart analysis. But three, they've got to recognize that the story can evolve on what they're looking at.
Okay. So let's get into it. You look at an area of really special situations, but specifically spinoffs. Now, most people have some idea what spinoffs are, but you not only fish in that pond, you really do the research in that area and find a lot of opportunities. So let's go right through here for a second. What is a spinoff for the layperson who has no idea what a spinoff is, and why are they so lucrative?
And that's a great question. So a spin-off is a separation of a business from another business, which is spun out, essentially given out onto the open market without you subscribing for the shares or buying the shares, and you get them whether you like them or not.
Okay,
right? That's the one. Okay. That's the one-liner.
So this is not an IPO, initial public offering, where I have to go buy something or have to research or there's a lot of hype. This is a big company. For some reason or another, you'll share with us why in a moment. They decide to spin off to current shareholders a piece of the business to make themselves, maybe it's not profitable, maybe it doesn't fit, maybe the business will do better. So for whatever reason, they spin it off to shareholders. Is that more or less what a spinoff is?
Yeah, pretty much. And I think the overwhelming, the overwhelming line within that, Charles, is, like I said before, you're going to get it whether you like it or not. So you're going to end up, if a company decides to spin off, let's take an example for a recent example, like a lot of your clients, a lot of mainstream investors, the everyday investors, should I say, has IBM maybe in their portfolio at some stage, right? IBM. We all know IBM. Now, how many of those investors maybe 6 months ago woke up in the morning, got another stock on their trading account, whether it's Schwab, whether it's whatever, and it was called Kyndryl. And they're looking at that, they're saying, Kyndryl, KD's the ticker. What is that? Why is it? Why have I got it? Well, you got it because you own shares of IBM and they decided to spin off their outsourcing computer business. And you got it. So what do you do with that naturally as an investor? If you don't understand something on your portfolio you just get rid of it. So there's been a number of these through the years, and like I say, investors will wake up in the morning and they just won't understand why they got these shares from. And that's part of the dynamics of spin-offs, and particularly in this market, as I heard to earlier, that you're just going to get them whether you like it or not, and you're not necessarily even going to know that you got them, and you're just going to sell them. Right. And that provides opportunity just in there itself.
Right, because you have shares in the hands of people who never wanted them, who don't know the value of them. And I didn't buy IBM to get this small little division. I bought IBM to get IBM. So out, I sell it regardless of price. Is that more or less right?
Absolutely. Yeah, absolutely.
Okay. So let's take a step back for a second. Why would a company decide to do something like this? To spin off like, was it Kyndryl? Why does IBM, huge company, decide to say, you know what? Let's give this part of our business, let it run as an independent company, independent managers, separate checking accounts, separate business altogether. We're going to give the shares to shareholders, and they usually have some type of proportion, right? They say for every one share of IBM, you're going to have 2 shares of this or something like that. So that's known. Why does management do something like that?
So that's a great question. And why would they do? Why would they do something like that? Right? There may be 10 answers to that question. So let me give you 3 of the more not basic but more common ways. Now, when a company decides to spin off, they'll give a reason, and they would give that reason with the spin off. They'll say, you know what? 1, we want to realize greater valuations for 2 distinct businesses. Let's say one looks at the cloud and one looks at computer services, and then they say, well, it just doesn't fit with a business. We can get a better valuation for 2. We can enhance shareholder value with that, right? Whether that's true is a different question, okay? Because
let's hold up there, because right about now, when we'll be broadcasting this podcast, it's the anniversary. I think it's now 7 or 8 years since eBay, a company that most people know, spun off PayPal. So PayPal was part of eBay. Management decided, you know what? This is back in 2015. it doesn't fit. Could you just walk us through that, Jim?
Yeah, absolutely. So you had a payments business and you had a marketplace, right, at the simplest level. Now they said, and I think it was some activist intervention by Carl Icahn as well at the time, if I remember correctly. But what they said was these businesses don't fit together. We can realize two distinct valuations for the business. Now we can separate those, and you as a shareholder of eBay will get shares of PayPal. And for the moment, when that come out, and I think I was one of the first to say, actually, it wasn't a good deal, and the shares kind of collapsed really on when they listed. But it went on to be a very, very good company. Look, the rest is history. Where there's been more payments, there's been an impact on their business, things like that, and the share price has come down. But initially, there was huge value creation after the fall of PayPal. That these were two distinct businesses. So the premise of that, as you know, Charles, is the fact that the one plus the one equals three. So we're getting a greater entire valuation for the businesses as a whole, broken up,
Right?
and it releases value. So that's the great evaluation.
Right.
So two distinct businesses argument.
Because PayPal was snuck in there, and the street doesn't know how to value it. It's tucked away in eBay. It doesn't have its own visibility. So management looks at that and says, we can get more for this if it stands in its own limelight on its own than we can tucked in here. And I think, learning from you so many years is that many of these companies are, you're just doing unbelievably well, these smaller companies within the bigger companies, these divisions or segments, but the big companies just siphoning off all that cash. So it never, it's like, Cinderella. The ugly sisters go to the ball and she stays home.
And you're right, and that's one of the reasons I think that's the good. And if I give you the bad and the ugly, so a lot of your investors will know Honeywell, of course. Honeywell, great company. Now, a few years ago, they were approached by an activist to break up their business. In fact, we were slightly involved in that as well. But what they did eventually was they broke up into three parts. Now, what Honeywell shareholders got was Residio and I forgot the other name of the one now. Residio, the other breakup, will come to me in a second. But both of those companies were spun off. Now, what Honeywell did, sadly, was dump all its debt onto the spin-off companies, and those spin-off companies suffered. I mean, it's just like me saying, Charles, you're my child. You know what? We're going to move out to North Carolina, which they did, from Jersey. And by the way, I've got all this debt. I'm just going to give you that, if you don't mind. Get your hand lit, and we're going to fly. Right. And Honeywell stock flew, and the other ones, Residio, went to almost into bankruptcy and out of bankruptcy.
And the other was Garrett. So the other one was Garrett.
Garrett Motion, of course. Right. I don't know why that escaped me. I mentioned that the other day. But so you had these two companies. So what they did, they just dumped all their debt. Like I say, the difference between when a company announces what they're going to do and what they think to what they actually happens is where we come in and we analyze it, right? And we say, well, hold on a second. They said they're going to realize better valuations, but what about this $1 billion of debt they just put in the company? And that's not going to realize as much of a valuation. So that's where the analysis comes in. But on the face of it, that's another reason why a big company might, spin off a smaller company just to make it cleaner. And it's not that ethical, really, if you think about it. If you're my child and I say, Charles, there you go, there's $1 billion of debt, we're off. Can you deal with it, please? You'll be like, hold on a second, how do I do this?
It's like the shareholders, be damned. They have to figure it out. But here's the thing, Jim. Here's the thing about this that you really specialize in and you're really good at is you look at the spinoff as its own company and you do a lot of the really legwork and analysis that most investors don't do. And it's not because they don't have the time. It's that it's such a uneven game because they're getting a stock they never wanted, they never paid for it, they never intended, they never researched. So you have a situation where shares of a company are given to shareholders who, mostly institutions, don't want them. And that's what creates the opportunity. Is that right?
think partly, yeah. I mean, and I have sympathy with investors. Why should they get a share that they don't know anything about? It could be a smaller company, a tiny company, put on their books and told it's for the greater good. Well, I mean, what do you do with it? So exactly. So that's where we come in, and we're looking at these spin-offs in the case of, whether it's just like you better get rid of it straight away because it's going down, like in the case of Kindle of IBM, where we
Yep.
said, you know what, it's worth $10. It went from 20 to 10. I mean, if you're an investor held in that, you'd be saying, hold on a second, what did I get? What did
Yeah,
they give me?
yeah. And
So,
mhm.
you're not creating any value. So the key is really, and like I say, it does take work, it does take analysis, but the key is to find, but that's only part of it on the spin-off as well. There's also, we can come to this on spin-offs that are around now as well, which have got discarded by the market because they can make really
Yeah,
great
yeah,
investments.
those orphan companies that no one's looking at. Definitely. I want to get to them in a second, but I just want to stay on this for one more second. And I find so fascinating, Jim, is that most people don't know of how many companies that are household names that were born from a spin from a bigger company. For example, most people don't know Chipotle was spun off of McDonald's. McDonald's was a big, they owned Chipotle. And they spun
Yeah.
that off in 2006, and Chipotle went up, I don't know, 3,000%.
Well,
Yeah.
I think I might mention this story, but I had a guy come up to me and he said, Jim, he said, you know what? I was speaking at a conference. He said, Jim, I had McDonald's and they gave me this stock called Chipotle, and I knew Chipotle. He said it was pretty good. He said I got given it like $13. It went to 20, and I got rid of it. I thought it was the greatest trader in the world. And then it went to like 2 or 3 thousand where it is now.
Yeah.
But he didn't know what the value of that was worth.
Right.
And
And
it
then, by
could
the way,
go any way on
in
that
all
basis.
fairness, he bought McDonald's. He knew a fast food business of burgers and fries. He had no idea about tacos. And so when he's given this stock, wakes up one morning, McDonald's decides, we want to focus on the Golden Arches and not on Mexican fast food, which was a big mistake. Boy, if they would have had that, gosh almighty, that was, to spin off Chipotle was, I guess they look back every time and say, what the heck did we do? But the value creation of Chipotle was, I think it was up 2 or 3,000%, some crazy number. Well,
Yeah.
McDonald's, no slouch, it went up, I don't know, maybe tenfold. But this was a 20 or 25 bagger.
And the interesting thing about another interesting thing about it, Charles, is because they spin off. It's not always bad, right? Like I gave a couple of bad ones. The Kindle went down. The Honeywell dumped their debt. A lot of them are very, very good. And we done a study on up to 2015, and we're updating our conference on November for 22 years. But it shows that these niche businesses are very likely to get taken over. Now, let me give you a little bit of a secret, a little bit of your listeners for an insight, because we've just found out that where we thought that about 30% they get taken over about 2 years. Remember, these are niche businesses that get spun off into the market, specializing in what they do good with top management who are good at what they do. So their incentives, their entrepreneurship, their skill will enable great business in the future, right? Okay, our job is to identify that, but take that for the moment. So we have a system in the States where at 2 years, we have a takeover rule. Now, if a company gets taken over, if a spun off company gets taken over before that, the acquirer has to pay the tax. If they don't, around 2 years is a prime time for them to get taken over. Now, in our spin off study, we found out that around 30 to 35% of spin-offs get taken over around that 2 year rule. And that's why, because they're totally niche, great businesses. Now, what our study suggests now, and here's the insight, is that number has gone higher.
Hmm.
So, in fact, there's more spin offs, but there's probably better quality spin offs. And initially, when the parent might dump the company, let's say it dumped it for a bad reason, like a Honeywell, and then it goes into bankruptcy, like a Residio. But then you can analyze that when they're down there, they can come back for a tremendous return. So this might be a lot for your listeners because they're thinking, oh, it's a lot to do. But that's what we do in
Hmm.
terms of
Hmm.
finding out the value of
Right,
these names.
right. So, for example, it's another thing which I was looking at a couple of weeks ago. Uh, Circuit City had a used car dealership buried in there, and that was CarMax. And they spun off CarMax. Most people don't know that Circuit City And that's another thing. Circuit City should have kept CarMax.
Yeah,
Circuit City went out of business, but CarMax is a fantastic company,
yeah,
a leader in the used car market. And
and you're right. Yeah, sorry,
no,
sorry,
no, I'm
Charles. And
just
I think that
go ahead.
I was going to say that ultimately the company initially might be thinking, oh, you know what, we're just going to say it's at a better valuation. We're going to spin off. We're going to dump the debt on it. But it puts out when you put good management. It's one of the things we analyze as well. You put good management into a bad business that's on its arse, let's say, and they turn that around, then you can get very, very good businesses. And what was initially was bad, if you were given a business, you're an entrepreneur. A lot of your listeners are going to be entrepreneur. If you were given a business, first thing you were looking at, right? It's a bad business. How do I turn this around? How can I refinance the debt? How can I put people incentives so they work harder? And all those sort of dynamics come into play on the spin-off companies because they are brand new companies come to the market. Now, contrast this with IPOs. Now, IPO has gone from 100 billion last year to about 5 billion worth this year, right? Why? Because no one wants to buy companies because they're manufactured companies. I want to sell you at the highest possible price to make lots of money for me. That's a bad investment right off the bat. With the spin-offs, you're getting them where you like it or not. The company, you need to work out, or we need to work out what the dynamics are behind that, whether it's value creation or they're just trying to get rid of a bad company and actually it's going to fall and then you're going to buy it. And who are the management and how they incentivize and all those sort of things can be particularly interesting for us when we're trying to spot investments.
Right. And now, from I'm seeing it out there, and tell me if I'm right on this, is that bigness is bad. Companies are now taking the conglomerate and they're breaking it off. Deconglomeratization is now the new thing, and we have some humongous companies, well-known names, and I think you have three of them in the article that we'll go through in a sec, that are now spinning off, and it seems like a win-win. The parent's going to do well, and the spin-off's going to do well. So, what do you see? Do you see that trend happening with bigger companies looking to get smaller because bigness is very, very hard to manage?
Well, your listeners are here at a special time because if they want something, a little bit fresh, but in their wheelhouse, in the value investing wheelhouse, and good investing wheelhouse, should I say, not even value, good investing, smart investing, then spin-off's a place to look because from my experience, and I've been doing this for a long, long time now, the spin-offs, some of the best ones to short are the tops of markets where the valuation gets full. Maybe it's a commodity, maybe there's something else. But what the really interesting ones are when markets are retraced, right? Look, we can argue all day whether it's the bottom of the market or not. Who knows? But when markets are depressed, like they are now, valuations are on the cheaper side, and you get companies that are spun off and you're going to go, well, hold on a second, and they're like this, I'm going to sell it. So they become even cheaper. That's where investors need to look. Now, why is this happening? To answer your question, are they going to get more? Yeah, they are. We've got another 12, 13 spin-offs before the end of the year, for example. I mean, this is nuts. So why is that happening? Well, I'll go into those companies in a second, but just to give the listeners a background, it happens because you can't IPO. We've seen that. IPO markets collapse. You can't sell a company. Do you want to buy a new company from me in this environment? Of course you don't. And SPACs are a dirty word, right? SPACs are never coming back. So those three methods of actually getting rid of companies just don't work, right? So what's your last resort right here to try and create value? And as a manager, you need to create value. Can you raise the prices on people in environmental recession? No, of course you can't. Can you try and increase your margins? Probably not. So where's it happen? So if you've got businesses within businesses that are naturally better for a greater valuation, then you're going to come to the spin-off space and you're going to spin those off to existing shareholders, and you're going to hopefully create value that way. So that's why there's more of these happening.
Yeah, and I see now, I saw in the first half of this year, there were close to 700 or so CEOs of public companies that either resigned, were fired, or retired.
Interesting.
Yeah, so it's that, if they're not creating value now, and especially with the chips down and the markets down, the economy's, running into a wall, if they don't create value, these guys are being shown the door. So one way they're showing value now is to spin-off companies, spin-off divisions, spin-off segments to create shareholder value. Otherwise, activist investors just, they'll show them the exit door rather quickly.
Absolutely. And one of the ones, and we work for activist investors, and if you look on my blog, you'll see Hillenbrand, which is one that, I believe should be spun off. I think the company going through a strategic review right now. But, activist investors will be buying at the heels for some of these companies because, it was easy. It's been easy for CEOs. They sit in their chair, share price goes up. Look at me, I'm great. We all make money when the market goes up, right? It's when the market comes down, we'll see how good you are. And we'll see how good you are because, and I wrote an article recently, wealth is created on the way down. And that is a hugely way out there.
Yeah, let me stop you, Jim. Let me stop you. And that's something that I write to my subscribers all the time, and most people don't get. You make money in a bull market, but you create wealth in a bear market. I want you to elaborate on that because you're one of the few people that do get it.
Well, I think that, I've got a slightly contrarian brain. Well, I've got a very contrarian brain in most things. Does it make me everyone's biggest fan? Not really, but I say what I think. And I think that as the market comes down, contrary to popular belief, risk comes out of the market. It's not increasing more risk. When the market goes up, you're increasing risk by holding stocks. When the market comes down, it's de-risking. Now, people don't view that. They're like, what do you mean de-risking? I'm riskier. Things are going nuts. We're going to recession. No. If the price comes down and valuation gets cheaper, you are having less risk for being in stocks. Now, if I can have less risk and buy good quality companies for the longer term, I'm not talking about 3 months, 6 months, right? We don't know what's going to happen. Markets all over the place. I don't really care. But if you can buy good quality companies at cheap prices, you're going to have those stories in 10 years. You're going to say, you know what, I bought Amazon 10 years ago. You know what was happening then? Everyone thought everything was going to zero. Credit Suisse was collapsing. The economy was going mad. We had a lunatic government doing everything. And I bought Amazon. And now look at it, right? So, if you can spot good companies in a down market at great valuations, you're going to be benefiting 5-10 years now. You're going to be laughing. And here's the big but, it takes a lot to remove that emotional edge from yourself to say, well, hold on, I think everything's going to zero. Let me give you a clue. Everything's not going to zero. And, from American companies, you've got an S&P index, which is fantastic. The best companies in the world. Never forget that. The S&P 500 are the best companies in the world, and you can invest in that at a low price. Now, if I give you that opportunity as it is, you're going to take it. Because you just have to grin and bear it for the short-term volatility.
Look,
so that's what I mean about creating wealth.
I forget where I saw this, but there was a great quote. It said, if you're buying stocks for less than 3 years, you're a stock picker. If you're buying them for more than 5 years, you're a business picker. And business pickers make money because with the stock,
I'm a massive fan of that. You have to invest like you're an owner.
Right. If you own a business, what could happen over the next month, next quarter, next year? Who the hell knows? But over the long term, you have to basically say, will this business be materially higher 5 years and 10 years from now than it is today? And if you can't answer that question, you should not be buying the company. But if you can, with some degree of certainty, it's hard not to make money.
And I would add into, and I agree with you, Charles, and I would add into that for the listeners that they should be looking at great businesses, but not so much on their feeling as well, because a lot of these businesses, like I said, I think the big tech you were here to earlier, where 3 years ago we thought everything was Amazon, Facebook, Google, and that was it. Right now we're thinking, well, hold on a second, these aren't the biggest tech things ever. They could be a lot smaller. There's a big breakup value in Facebook right here. So you've got to look at businesses where, yes, they're going to be material value, but you also got to have the analysis to back that up and say, well, you know what? Is anyone really going to create another Amazon over the next 5 years? I'm not so sure. Yeah. Is anyone going to, that's what you got to put. So those big businesses, if they're cheap enough, make sure they have an edge and a moat, I'd say, in Buffett terms, around that to take them further. And a visionary leader. I'm a big visionary leader fan. People don't like Elon Musk. He's a visionary leader. You take it or leave it, right? I don't care. But these are the sort of people you need to invest. Do you like Jeff Bezos? Do you like Zuckerberg? Everyone will probably shake their head. These are visionary leaders.
Yeah. So now Well, let's just, as we get closer to the end here, I just want to want you to give your insight. There are three household names of companies that have been around 100 plus years. I think one of them was the original. Yeah, generally, one of them was the original entry in the Dow Jones. And these three companies are now going to be spinning off their subsidiaries, parts of their business over the next year or so. So let's go through them. And the reason is, I think you wrote well about it, is that it's hard to manage big, diverse businesses. It's just not. It's not a value creator. It's like a two-headed llama. One end is pulling, one end's pushing, and it's hard to run huge businesses, as we're finding out now. As when the tide goes out, you get to see you swimming naked. A lot of these businesses are having problems. So let's go through them one by one. General Electric, one of the original in the Dow. I think this company's over 120, 130 years or so, probably even more. They're going to be spinning off their health. They're made up of what? Three companies, correct? What are the three companies they're made up of?
Well, so let me give you a background about General Electric because I think it's important first. Everyone knows General Electric, right? It was the company, and I haven't been in America as long as anyone on this listen, I guess, has, but it was one of those companies where you had you were told to get into it, right? You were told to buy it. What? You haven't got General Electric? What are you, nuts? And that was forced on a lot of people. And that was the right thing to do. And it grew and grew, and it was under great management. And then Immelt took over, and he in fact destroyed value completely. And there's a big argument for that. We won't go into that too much, but what it comes down to is General Electric was probably one of the worst, America's worst disasters in companies, really, the way that fell. So we had some new management take over. They looked at what was going on, and they started to say, well, hold on a second, this company does everything. Today it's just not viable to do everything. You just can't do it. And can you have a zillion businesses at once? No, I'm not sure you can. So this has been on a radar since I say January 18 for potential value creation opportunities. And a few years later, he announced a three-way breakup. It's going to take place in two parts. GE Healthcare by 2023 and GE Renewable Energy and Power spin-off to be called Vernova, GE Vernova by early 2024. This leaves its aviation business as the core remaining business. Now, listen, this leaves the complex nature of this leaves it huge room for mispricing on where the cash goes, where the debt goes, what companies come out better, what the management are. And this takes real analysis. Now, if you want to make the most of that, and you ask me why do people come to us, they say, Jim, I need your expertise on what company is the better company to go for. Now, I had a chat with, just a side note, on spin-offs. I had a chat with one of the big GE analysts on the street, and he said, after January next year, I ain't covering GE anymore.
Right.
I'm like, why? He's like, well, because then they don't do what I do anymore, right? So, that's where they kind of get dislodged, in your term, orphan securities, where they get dislodged and people forget about them. You're saying people are going to forget about this part of GE. So this company is split into three for value creation. Now, this is kind of on its last leg. So they got to make some value here. So it's going to be super interesting, but it's going to take a lot of work to find out where the value is. So that happens pretty soon.
Okay.
Q1 Healthcare,
right.
and energy.
So we have General Electric, which was founded in 1892 after 130 plus years, realizing we cannot manage three separate businesses, and they're going to spin off their healthcare and the aviation business. Is it the aviation or the power business, I think, right?
Yeah, they're going to keep the
right.
aviation.
So they're going to keep it, and one shareholders are going to wake up one morning and see shares of the healthcare, and then they're going to see shares of the power business.
And you're not going to be told.
You'll
have something through your email, whether you see that or not.
Right. And most people would have no idea what the valuation of this new GE healthcare business is. They'll probably sell it, and there's the enormous opportunity. Okay, that's number one. Number two company that you talked about is Johnson & Johnson, which is...
Everybody knows it.
Yeah.
Everybody knows the company, but how many people know they're spinning off? Probably, I'd say very little. again, people know about the business, and big pharma, it's always been reasonably okay, really, as an investment. I'd say slow burner, nice dividends. But you've had the major players come into play in the last few years. Pfizer, for obvious reasons, with a vaccine, whether you agree with that or not. They spun off as well. GlaxoSmithKline, in separating their consumer segment. So big pharma, again, that big word that goes with pharma is not so fashionable anymore. So those guys are slimming down. And what Johnson & Johnson are doing are separating their consumer health segment to focus on developmental drug portfolio. Again, the kind of dynamics of what they do is all kind of a bit of marketing for them. But in this transaction, J&J will spin off its consumer health segment and retain the pharma and medical devices segment. So that's what they're doing. They're kind of creating value that way. It has little debt. What's interesting about Johnson & Johnson, it has very little debt. And very little pension liabilities. So it's actually a very good company. So we're expecting, this is going to happen in Q2 23, we're expecting there to be value creation out of this one. And what can investors do now? Well, ahead of that, they can sort of, start accumulating the shares maybe if it's a cheap valuation.
Right, right.
Their own sources.
Buy shares of Johnson & Johnson now, so when the spin does happen, and by the way, the shares are down, due to this bear market, when the spin does happen a year from now or so, they wake up one morning and they have shares of the consumer health company.
Yeah. And what we're seeing, Charles, is a lot of that value coming up to the spin in good companies. Let me make that decision. In good companies on the rally up to the spin, and it is a rally because the value starts to get embedded, in the share price, and that's why you rally. So investors here are very early. Your listeners are very early in being able to look at this. Again, check in with us, check in with your broker. They probably won't know anything. But once stuff gets filed, you're going to be like, well, this is where the cash is going. This is where the debt is going. This is the better company to hold. But ultimately, you're buying a good company right now in Johnson & Johnson.
Right. And like you said, most analysts, when these kinds of things happen, they just walk away from it or don't cover it as well. It's just there's too many moving parts.
I spoke to Joel Greenblatt, actually, and who everyone's going to know, and he wrote that ridiculously titled but fantastic book, "We Want to Be a Stock Market Genius." And I said, you know what, Joel, when you wrote that book in, I think it was like 97, everything's come full circle. Nothing's changed. Yeah. People sell the spin-off, analysts don't cover it. No one knows what's going on in them with spin-offs. Nothing's changed. Nothing has changed, which is frightening, really, considering we claim to be sophisticated investors. We're not. Nothing's changed.
Yeah, and you know what I found, from my years working on Wall Street, knowing so many people like you, well, I think you know a lot more people than I, is that most of these analysts, a lot of great ones, many of them don't want to work that hard in areas where they have to go out on a limb and do a lot of investigative journalism and act like Sherlock Holmes. Because it's much easier to call up the CFO and get some information and then look at what everyone else has researched on this. But to tear apart a company and look at it from the ground and say, what's going to happen here? You know what? I'll find a company that's easy to do and then move on.
Well, if our business is evidence of that, we've grown. We've grown in the space. People come to us for that reason. Yeah. And like you say, it's how many analysts who say to me, like I say, they take the GE analyst, for example, and he says, well, Jim, I don't do aviation, but I do the other bit, and I don't do that bit. It's like, well, is he going to break up the company and give it? Of course he isn't. Where's that little piece gone? Where's that bit in the middle that someone has to do?
That little piece will probably go on to be an orphan until it becomes enough a time in the marketplace where some analyst in aviation will pick it up and cover it. But till that time...
And that could be 6 months, 9 months down the line.
A year plus.
Appreciated 50%.
Yeah. And the last company, which is another... So we have one company, General Electric, which is going to be spinning in, which was founded in 1892. Other one was Johnson & Johnson, founded in 1886. And the last one is on everyone's breakfast table, most people, is Kellogg's, founded in 1906. They're going to be spinning as well.
Well, we say, exactly. I always say Kellogg's. It's in fact Kellogg. but it's Kellogg's on the box, but the name is Kellogg. It's kind of odd, really. But I thought that, I'm a big fan of intermittent fasting and all that. And I thought, people aren't eating breakfast anymore. But then, for Americans, I saw a study the other day, breakfast is one of the most important meals of the day. So that aside, it was just a side note. But what Kellogg are doing, they're gonna separately listed their fast growing global snacks business from their plant based business.
What are some of the global snacks that most people know about?
Global snacks are going to be things like forgotten on my head, Charles. Now you put me on the spot.
You're real.
I can't think of the main ones. That, huh? I don't eat snacks anymore.
All right, so this is one. Yeah, that's true. Jim, for those of you who don't know, is a triathlete, and he rides his bike in all sorts of weather. One of the famous ones that Kellogg's has, which most people don't know, is whatchamacallit, Pringles. No.
Pringles, that's right, Pringles, and I never eat Pringles.
No, I don't think you would.
But I mean, like just on the basis of just looking at an investment like that, Charles, what I'd see is changing consumer habits, young people, they're not everyone like us, right? We like to sit down and get a few Pringles out, maybe not me, but used to watch a movie, whatever. I mean, they're not desperately doing that, young people. They like a little bit of plant-based stuff. They don't like to eat too much. Whether you like it or not, it doesn't matter. I keep saying that. Whether we like it or not, it doesn't matter. But recognize the environment, recognize what's going forward, recognize the changing cultures, and put a common sense. It doesn't always have to be about numbers. Put a common sense lens on it and say, yeah, this is interesting. Plant-based foods, am I interested in them? Not desperately, but a lot of people are. Yeah. So, that's what you got to look at. So they're spinning off as well.
Yeah, with Kellogg's, they're an old company, and they have really iconic brands. There's Eggo and Pringles and Cheez-It and Nutri-Grain, and then you have the cereals Frosted Flakes and Kellogg's, and then they have the plant-based, which is very small, which is this, the meat kind of substitutes. What do they call that? Morningstar Farms and all that. So investors are going to wake up one morning and be given 2 different companies, then go on with them and not know what to do with them.
And they're not. And they're just, your natural inclination is just going to sell it. I don't know what this is. Right. It's going to appear, and this is the worst thing, it's going to appear as a credit. It's not going to appear as a loss. You're going to have a credit. You're going to have a credit. And what you're going to do, and especially, and this is why I come back to these sort of bear markets where you've got, I'm going to give you money, Charles. That's what basically he's going to look at. I'm going to give you money on your account tomorrow. And you're going to see a bunch of money on your account. You don't know what it is. I'll take that. You sold it, right?
Just get rid of it.
Sadly, that is the mentality that hasn't changed.
Hey, Jim, if it wasn't, we wouldn't be making money, and you wouldn't have spinoffs outperforming the S&P by almost 2 to 1 over the past decade or so, 2 decades. And you think about it. I always think when I look at these spins, do I own McDonald's and I'm passing on Chipotle? Like, is this the next Chipotle? You don't want to miss that. A 20 bagger or 25 bagger that was given to you, and you watch it go up 50% or 60%, I think, the first couple of days, and you said, wow, I feel like Warren Buffett. Let me sell, and I made $1 zillion. Or, owning Circuit City, and when you were given CarMax, you said, I invested in electronic superstores. I don't know anything about cars, used cars. So there's so much here, and there's so much inefficiencies, and that's really where you and your company and your team shine.
And I thank you for that, Charles. And I think that, the investors are clearly, the mentality, sadly, with any investor, not just yours, not just me, ourselves, and we've got to check our brains on this sometimes, is we want to snatch at a profit and we want to let a loss run. Yep. Right? That's the way we are.
Yep. Folks, Jim Osman, The Edge, you can follow him, which I do on Forbes. He's a Forbes columnist. He puts together 1 or 2 articles a month or so, and you can go back and look at them. I'll put a link down below in the description for Jim to the articles. Really fascinating stuff. You give away everything in these articles. And by the way, you're one of the few people who go deep into these articles. You give your analysis. It's like the stuff that you sell for 12,000 plus, you just could follow some of your articles and get tremendous insight. Yeah.
Well, thank you, Charles. I appreciate it. Like I say, I'm passionate about helping people. I'm passionate about people winning. Hope that comes through. I've got another article tomorrow. I'm going to try and produce 1 a week going up to December. It's my book coming up. That won't be out till next year. But like I say,
what's the book on? I didn't know you wrote a book.
Yeah, I was asked to write a book by a couple of people, which sounds like I'm a bit special. I'm not, but it's about special situation investing. And like I say, I'm getting everything I've ever
All right.
lived and experienced, good or
I
bad,
want
and putting it
put
down.
down the first copy. Well, maybe the 10th copy. You give it to your family, sir. But definitely, I want one of those copies signed by you. A
Absolutely,
lot
man.
of good
Let's
stuff.
watch out the Forbes blog, and like I say, get check in if you need me. And I
Yeah,
appreciate your time.
definitely.
And
And one more thing, I just want to call out because there are some guys on Wall Street that you would check your pockets after you speak to them, but Jim's not one of them, folks. He gives back. And one thing that Jim has done for the past several years is he runs a conference free of charge for a small group of people, and all the money raised, which is voluntary, you can give, is for Alzheimer's. You want to just plug that for just a second, Jim, why you do it and how successful it's been. And I've been to several of your conferences already.
thank you, Charles. I appreciate that. Yeah, listen, I've got passion about the finding a cure for this terrible disease. And we are at the conference, 17th of November. We're about to put the invites out in the next week. But it's a charitable conference. 100% of what everyone gives by the little fee that Eventbrite take goes to the charity. It's got bigger and bigger every year. Bloomberg, WSJ, Barron's are covering it again this year. We get special people there who have real insight, who give up their time. You get a little bit of stuff from me, which is not the interesting part, but you'll get some proper people giving their advice and ideas, and people come for ideas. So it's one of those situations where everybody wins. The charity win, yourself wins because you come with ideas. You get a free breakfast on me,
Yeah.
and the speakers get some publicity. So it's one of those rare occasions these days where everyone wins. We're in New York City. We have a maximum of 100 people only, 17th November. If you want to check in on the website, say you want to be put on the list for the output when it's done, then check in. But yeah, passionate about the charity, passionate about helping people.
And Jim, I think this is the first year you're not having it on Zoom, right? Last couple of years it was, or last year was the first year. I don't remember.
Yeah, the last couple of years, for obvious reasons, on Zoom. It went pretty well, to be honest. We raised our most ever last year on Zoom. But I just like you. I like meeting people, I like shaking your hand. I like smiling. I like eating some food, and I just like seeing people. So it's back in person this year. The Penn Club, Ivy League Club, fantastic place. Love it. And looking forward to seeing you, Charles.
Yeah.
And,
hopefully, last couple of years we weren't able to make it for obvious reasons because of the pandemic. But I hope to come and bring my analyst with me because we had a good time the first time. I think it was 3-4 years ago we went.
Yeah, really fantastic. Got some great speakers lined up and about to announce those in the next week. But thank you.
All right, beautiful. Okay, folks. Jim Osman, a special situation, he's the man. I tell you what, when I have a situation with a special situation or a spinoff, it's his work that I look right at, and he's good. He's just good. There aren't that many people 35 years in the business and know what they're talking about. So Jim's one of them. Jim, I want to thank you for your time, man. Continued success in all that you do. Thanks so much.
Looking forward to catching up. Thanks, Charles.
Take care. Thanks for listening to this episode of The Charles Mizrahi Show. If you're a new listener, welcome. If you've been listening for a while, we're glad to have you back. Either way, we'd love to know what you think of the show. Please leave a review if you listen on Apple Podcasts. Reviews make it easier for others to find the show. You can also see the video of the interview on the Charles Mizrahi Show channel on YouTube.